Our long-term bear market's dead. Anybody want to jump in on that?
To answer it succinctly, I don't know, but I've had seen the trend being more recently is the expectation of a V-shaped recovery every time we see a market drawdown. I mean, that's been the situation, I guess, since COVID, where we see that V-shaped recovery. I, however, don't think that's going to be sustainable going forward. A lot of market movements right now are being driven by sentiment as well as policy, and the Fed has this razor-thin margin of not making a policy mistake. They're trying to juggle inflationary pressures from tariffs, coupled with a weakening economy that's starting to show up within the labor market. My thought being is we're not going to see these V-shaped recoveries going forward forever.
Welcome to this week's panel discussion from Investment Masterminds, brought to you by Swan Global Investments. I'm Jeff Thomas. I created Investment Masterminds to bring the best ideas from across the industry to you, the financial advisor. As much as financial services have evolved, there's one constant that will never change, and that's the human element. Robo-advisors cannot account for the emotional challenges involved in investing. That's why I'm excited to introduce our panelists who will cover the topic of designing portfolios for today's investor. So today's panel has actually dedicated their careers to creating scalability for the advisors they work with and allowing advisors to focus on what they or you do best, which is helping clients and their families achieve their goals. So let's begin by introducing our guest speakers today. We're going to start with Lee Cook. Lee is the Senior Investment Strategist from Freedom Street at Steward Partners. Thanks for coming on the program today.
Thanks, Jeff. I'm thrilled to be here alongside Anit and John. This is a great opportunity. So I guess first off, I'll just start with a little background about the firm I'm currently at, Steward Partners. So Steward Partners is an employee-owned independent financial services firm that provides full-service wealth management solutions to all types of investors. So our headquarters are in Stamford, Connecticut, but we have nearly 300 advisors across 76 offices nationwide. So I think one of the key advantages of Steward Partners is that we give our advisors true independence while also backing them with the resources and the infrastructure of a larger organization. So this strategic partnership, it really helps support our advisors with contingency planning and long-term succession plans. And over recent periods, we've experienced a lot of strong growth, both organically as well as through various acquisitions. So firm AUM is roughly about 45 billion. And I'm pleased to announce we were recently ranked number 9 on the Barron's top 100 RIA firms. So I guess just briefly a little bit about myself and my current role. I'm probably aging myself, but I have over 20 years industry experience. And in my current role, I'm overseeing our legacy discretionary platform here at Steward. So the legacy discretionary investment platform, we're approaching 2 billion assets under management, offer a range of portfolio suites, primarily comprised of mutual funds and or ETFs. So it really comprises of what I call our 3 core portfolio suites, which is 100% active solution, 100% passive solution, and then a hybrid option. And we also offer some specialty portfolios that are tailored to more specific goals, such as income-focused, ESG, tax-sensitive, and then lastly, a couple more concentrated portfolios that's targeted at those clients that have a much smaller investor base. So hopefully that's really Steward Partners and my responsibilities in a nutshell. So hopefully that provides a little bit of context.
What's the connection between Freedom Street? Because I've actually had Scott Danner, who's the Chief Growth Officer at Steward, but I think he was the founder of Freedom Street.
Great question. So Freedom Street was acquired by Steward Partners in the beginning of 2024. So with that acquisition, we brought over our discretionary platform, which I currently manage. And then Scott and his team are really heading up the M&A front and recruiting additional advisors to come under the larger Steward umbrella.
Perfect. Yes. And I'm a fan of the High Performance Life podcast, which Scott Danner runs.
Oh, he does a great job.
He's awesome. He really is. So life goals for me, right?
Yep.
Next up, we have Anit. Anit Deshpande and I met last month in the great city of Cleveland. We had a great conversation and I said, hey, you got to come on this program and talk about what you do for Clearstead. So he's the CIO of Clearstead, which is out of Cleveland with, according to Google, it's over 50 billion, but I think you might even be a little bit bigger than that now. And so before I give anything else away, Anit, thanks for coming on the program.
Yeah, thank you, Jeff. Thanks for having me, and good to be here with John and Lee. As you mentioned, Clearstead's a Cleveland-based organization. We were founded in 1989, approaching around 300 employees now, over a dozen offices, overseeing over 50 billion, as you noted. Our client base is really centered around the ultra-high net worth family office on the private client side, as well as endowments foundations. So on the family side, we're very much focused on delivering a planning and tax-first experience. The tax piece is supported by over 40 tax professionals, a big planning department. So when we were serving holistically for as an advisor for our clients on the family side, that is really the engine that drives investments for us. So that's something that we think about a lot in terms of starting with planning and ending with investments. On the OCIO side of the business, we oversee institutional assets for a broad spectrum of clients from hospitals and health systems, large corporations, higher education institutions, non-operating foundations, things like that. All of those clients are supported by the internal research team, which is all located here in Cleveland, Ohio. So glad to be here and looking forward to the conversation.
That's great. So you're doing portfolios within the firm, but you're also doing OCIO for those larger institutions, which I didn't actually realize was part of the overall equation. Very cool.
Yeah.
Yeah, so my friend John Robinson down in North Carolina, he's with Blueprint Investment Partners, and John's been on the program before. He's both an RIA, but also has outsourced portfolio management through model delivery for advisors across the industry, RIAs, and a lot of BDs too, right, John? Like LPL Financial. So why don't you tell us a little bit about the firm and why you got started and how you got started and all that good stuff.
Yeah, thanks, Jeff. Thanks for having me. I appreciate it. Blueprint appreciates it, and you definitely put a great panel together. So I'm excited about the conversation as well. Blueprint is an asset manager that designs systematic risk managed strategies. We primarily work with advisors. We do have some mandates and institutional level clients that we work with or partner with as we see it. But primarily we serve advisors, and really the business is set up in that way and has been from the beginning. We deliver these strategies through separately managed accounts, custom portfolios. We sub-advise model portfolios as well, in addition to running ETFs and mutual funds, both as a sub-advisor and an advisor. And I would say, Blueprint's work is really centered around building processes that are consistent, repeatable, and designed to help investors stay invested through all kinds of market environments. My role at the firm is I'm a co-founder. I am officially titled the CEO and co-CIO. So what that really means is I get to simultaneously do what I'm very passionate about and lead on the investment front, particularly on the R&D side, since we're a systematic manager, ensure the strategies get executed in that repeatable, very highly disciplined way and cause trouble.
Well, we appreciate the work you do. Investment Masterminds is sponsored, I guess you could call, from Swan Global Investments. And the reason that John and I are talking today is that he happened to find one of our ETFs. And we're glad that your process is good enough to find something from our firm, which we really appreciate. Let's start with Anit as far as just talking about what your portfolio team does. What does the team look like? Some of the work that you do on the customization side, and if there's some scalability between different portfolios you might design across the board for families and within the business, because it must be a huge workload to. I mean, you have multiple clients throughout the firm, and you're doing a ton of work for each of those. I'm thinking there's got to be some consistency there somewhere.
Yeah, it's a great point, great question, and it's something that we have, if I call it scar tissue, I think scar tissue of 15 years of having started in a firm while being founded in '89, really got into the private client business in circa 2009, 2010. So we've been able to pull together a singular point of view on how we think about investments and scale that across the organization. Some of the things in terms of team, and I'll just start with how we approach this from an organizational point of view. We have as I mentioned before, a dedicated investment team here internally in Cleveland, Ohio. It is, part and parcel of success for driving client outcomes, and it's organized by public equity, public fixed income, and private markets. And so we're generally looking at the world through the lens of each one of these individuals. It also includes a head of investment solutions, I should have added. So these folks are really organized in a way to drive manager research, investment ideation, asset class views, sleeve development within models, and overall sort of purview over those specific asset classes. One of the approaches that we've taken that's helped us sort of craft a more cohesive point of view across portfolios by client type is starting with a purpose-driven framework. We do a lot of work in the private markets, and we wanted to sort of get out of this whole traditional stocks, bonds, and alternatives point of view, focus a little bit more on what it meant to actually be invested in these asset classes. So we think about things through the lens of purpose. We think about growth assets. Growth assets include equities, be that public or private. We think about income and liquidity assets that could be both public and private in terms of whether that's a direct lending strategy versus a leveraged loan strategy or a high yield strategy. Those things are falling into that same bucket. And then we have a diversifier bucket as well. And so that allows us to think about asset classes without obfuscating the purpose of whether you're locking up liquidity or taking on daily liquidity. So that's been one thing that we've done that's helped affect scale at a platform level. We're always balancing this idea of customization with scale. And so what that means, in some sense, it could be just a fancy way of saying things are kind of in chaos all times. You try to put some rails and controls on it. But for what it means for us is we have to establish a firm perspective. We want a investment brand identity that people think of when they think of Clearstead. And so we start there, and then we adapt those into either prescriptive models for our, I hate to use words lower end, but our smaller clients that may not need the customization, and then work into more customized portfolios for our ultra high net worth, our kind of core client base. Ironically, they share the same attributes as perpetual endowments foundations in terms of appetite for liquidity and general thinking around private markets and tax efficiency may be one constraint or differentiator between those two clients. But for the most part, there's a lot of consistency in those two areas of our client base. So, I would say scale shows up as platform scale. So reducing the amount of managers on the platform, focusing on a high conviction set of managers to drive assets, to lower fees, to create new vehicles, give us the negotiating capability to drive new vehicles for clients, which I think is very important. And then portfolio scale, which, as I mentioned before, it really starts with prescriptive all the way to customized. And at the fully customized level, we're talking about using our platform, best ideas and whatnot. So that's really at a very high level how we're thinking about taking what is a very broad client base and narrowing it down so that the intention there is that if you're going to be different, you're different on purpose, not by accident. So that's really the linchpin of the whole process.
Yeah, chaos with guardrails sounds like my household, buddy. I mean, it's really that's pretty much what's going on all the time. Is having the chaos and just trying to keep it all in check. And really, that's a lot of what we do for clients, or you do for clients on the advisory side. So Lee, yours, I think you're working with a lot of high net worth and mid-size, I would say, relationships. How are your team getting together to do some of these things? And you kind of talked about, modern portfolio theory itself is probably still somewhere intact, but being intentional about how that allocation and that diversification looks like. So how does that work out through Steward Partners and your team and what you're doing there?
Yeah, so as I mentioned, our discretionary platform has a bunch of different portfolio suites, all of which are target risk. So each portfolio suite typically has 5 different targets, ranging from a 30/70 to 100% equity. The rationale behind that was just we wanted to design a discretionary platform that had flexibility in mind, that just offers a broad lineup of portfolios that not only had different target risk allocations, but also a different investment minimum. So for a client that has only $1,000, there's a solution for them. Likewise, if the client has $1 million, there's a solution. So just just a wide array of options. And that really, the rationale behind that is really to help our financial advisors by offering a very robust platform. They're able to focus more on the asset gathering and the building relationships rather than the portfolio management. And then it's also helping to solve, which I alluded to in my intro, the whole issue of succession planning. It's been a pretty hot topic as to
Good
there's
point.
not a lot of new advisors coming into the market, so there's been a hot topic of what happens when they retire. So by utilizing our discretionary platform, kind of takes a little bit away that worry, because the financial advisors, they don't have to worry about their successor really replicating and understanding the various nuances that are associated with more custom solutions. And I would say the last benefit to the discretionary platform, I think it also helps with client retention. So by outsourcing the portfolio management aspect to myself and my team, this essentially places the blame on a third party and not the advisor should portfolio performance not meet a client's expectation. So we're essentially the scapegoats, so to speak. which
I'm
I guess
glad I'm glad you're actually transparent about that, Lee, because that there is that part of it. At least it's, hey, you know what? We're here. We're the ones taking on that fiduciary risk of putting the portfolio together. And the advisors really for the broader relationship and bringing the pieces together sometimes. And there's other advisors that really want to do the portfolio management, and I'm sure that you have plenty of those as well. Is there Are advisors able to do both? Can they use your model plus do some customization around that?
Yep. So they can take a hybrid approach where they use our model portfolios and then they create custom solutions for it depending on the client's needs. So sometimes it typically I would say with higher net worth clients it scales up to more customization. But I've also seen too where they use our model portfolio as the core solution and then as satellites around that, they invest in different stocks or the things that I would say that are quote unquote like more fun and exciting and sexy than our steady Eddie approach.
Yeah, throw some Bitcoin there and see what happens. By the way, that's not a recommendation for Bitcoin. As you know, look at all disclosures before investing. And John, so I know that you've gone from being an RIA, having a background going back to I think 2003 with customizing some model designs, and then the latest variation of that is Blueprint, which I think is somewhere around 2013. I'm probably screwing up these dates, but could you talk a little bit about how you've created these models and what I know that you have both strategic and tactical, and how that all kind of came together, and what you do from a standpoint of broad-based, it's within a 5-minute period, because I know that within your process, I could listen to you for 4 hours on it, right? So it's got so many intricacies, but how those models kind of were developed, and who do they serve?
Sure. Yeah. The problem, Jeff, is that you could listen for 4 hours, but I could talk for 6, and nobody's got either. Yeah. So our models really just a little bit of history. So you're right. I started my career at Bear Stearns, came back to North Carolina to launch a managed futures fund in 2007 in a predecessor firm with the same co-founder, Brandon Langley. And what we learned in that process was that you can't sit across the table from a client, whether they be ultra high net worth, not institutional fund of funds, and you always say to them, "Don't you like math?" as your pitch to get them to stay in their seats and stay in the investment during an emotionally charged time, or just the natural ebb and flow, and it's typically the ebb in which you're having that conversation. So what we took from that was we were asked by a few investment advisory firms, independent firms, to start managing portfolios for them using the same philosophy that we had on the future side, to leaving the Wild West and coming over to a more, dare I say, a sophisticated and domesticated environment. So we started doing that in 2011, launched Blueprint in 2013, with the idea that we had to design and deliver strategies that helped the advisor, because the advisor is our client, but transitively, their client is our client as well. So we always say, we don't want to be the reason that a client calls their advisor, because rarely are they calling them to tell them what a great job they're doing. To Lee's point, right? I mean, she sort of hit on the same thing. And the money manager is always the scapegoat, in my opinion. So, willingly. So we wanted to really take into account the behavior of the client, not to do things antithetical to their rate of compounding, but really try to hit that tangent point of keeping their rate of compounding at or near its highest point, while at the same time keeping them in their seat so they could realize the benefits of the strategy through those ebbs and flows I talked about. So the way we do that is we originally took the research done by David Swenson and others in the endowment world, because we wanted to look at who has unlimited resources, right? We don't, but who does, and what are they doing? And so we took this 8 asset class approach. So we keep it really as simple as possible. And so this is, US equities, foreign emerging real estate, that's sort of your equity bucket, and then fixed income and alternatives on the other side. And we said, okay, we don't want to hold them, in our view, we don't want to hold them passively, because while that improves in some environments one unit on the behavior side, it may detract from the compounding on the other side. And those two things can be at odds with each other. So we take this very, what we consider to be almost all passive or active if they serve a purpose, like you guys, Jeff, approach with the asset classes, with the exposure. And then we overlay on top of that trend following that's systematic and done over multiple timeframes. So how that's delivered is, to your point earlier about there's a mix of strategic element to what we do, which is probably what most people are used to in terms of standard asset allocation with the rebalance, with the occasional secular shift in exposures, whether we lean into small caps, so we lean away from international, or hopefully this year lean into international. And then we put the trend following model on top of that to gradually step into things or increase our risk, or said another way, overweight things that are moving with us or the trend is up, and then gradually and methodically decrease the exposure to things that are trending down or moving against us. And we try to do that over multiple time frames so that again, going back to the client experience, we don't want to be binary, or we want to reduce the probability of being binary. And in some cases, it looks like we are, but in most cases, we're not, where it is that gradual step in, step out feel to the client. We try to limit the rebalancing, risk-based rebalancing we do, or the trading we do as in response to what the trend is telling us, such that we're limiting statement noise, we're limiting frictional costs, we're trying to be as tax-friendly as possible. So we have an eye on those things. But the primary motivation for us, or principle we lean into, is we always want to be with the trend, and we want to keep the rate of compounding for the client at or near its highest point.
Yeah. Yeah, it's a great point. I mean, that's a lot of what, starting in the industry in 1999, not losing the money first as much as possible gives you a lot easier ride on the way up, right? And that's a great point. So it's interesting because Lee was talking about some of their allocations models and the ranges from 37% to 100%. And it's interesting. I like the idea that it's not some arbitrary 33 or 50 or 25. Like 37 means there's some intentionality there. So Anit, within your process, when you think about the portfolios that you're designing for clients, and I know that yours are across the boards, different, unique, what would you say the value proposition is? Would you want to be the type of firm that would help to outperform in certain markets, like a bear market or recovery? Is that part of the value proposition, or is it more of just looking at more institutionalized, historic type of allocations that, hey, you have an allocation, we're going to try to get you a little additional upside? Like what do you feel is the real value proposition within Clearstead and the work you do for investment and on the CIO side?
Yeah, well, I mean, first, we're not afraid of being different. I mean, I think that's a necessary condition to being able to charge fees to clients. You have to, if you arrive at something that looks like consensus, but you do it through a process, I think that's fine. But you can't be afraid of being different. But I think generally speaking, success really depends on the client segment that we're talking about. So in OCIO for endowments, foundations, they may have very specific CPI plus 5 mandates, and how you're judged there and your retention rates on the clients are going to be almost wholly dependent on performance and or governance, or a combination of those two things, and what you're providing for that client. In ultra high net worth and family office, it's quite a bit different. Performance is, a lot of times our performance reports don't even have top level performance that you can judge against an index. We're solving different problems there. Succession, how assets are oriented, so it's asset allocation, asset location, the degree in which we're using tax efficient strategies that are kind of complementary to the holistic plan that we've developed on the front end of the process. One of the things I would say that we are getting closer to, where the industry, it feels to me, has to evolve to, is this disjointed financial plan over here, and then relate that to an asset allocation, rather that it should be a plan directly informing an asset allocation. That the problem with that is it creates some friction with scale. You can't, because that just sort of means that you have to have infinite degrees of scale. So the benefit of models there is you can approximate, and I love what you said with Lee. The reality is the degrees of specificity that we apply on asset allocation is kind of absurd when you think about it. Like, as wide-ranging as realized returns are against our own capital market assumptions, to sit around and think that the next 1% is going to change the outcome for a client, it's kind of crazy, but we all do it. But you need something to start off with. So I would say, one, it's getting kind of dancing around your question there, but Jeff, it's probably two-pronged. One, the value prop is getting closer in terms of asset allocation with plan for high net worth clients. And sort of writ large, it's thinking about tax effective solutions. We don't need more active product on our platform. We need more solutions that are driving after tax returns for clients. And a lot of the kind of the value prop that we have brought to the fold is in private markets. We've been doing it for since the firm's inception. We have institutional kind of pedigree of having done that in the past, and so we lean pretty heavily on that. Access is everywhere. I think everybody's seen the whole quote unquote democratization of private markets, and whether that's in 40X structure, be that tender interval or other semi-liquid structures versus kind of your traditional drawdown structures. We tend to be more on the latter. And it's primarily because we can ascribe performance to that benefit versus, the known certainty of buying a ticker, being able to rebalance it in a portfolio, and all the pros that are out there for those asset classes, or vehicles, I should say. So, different differentiators are going to be on the tax side, clearly conjoined with planning, and then separately on the private market side. So,
Yeah, there is, in some ways, I think the industry became broken because you took the simple idea of diversification between asset classes and then you just pump that out, not you, but us as an industry early on, pump that out as a marketing tool to say, hey, we're better or worse because of benchmarking. So Lee, I guess my question is, and this is a little bit off the script that I gave you, so I apologize, but when the idea of benchmarking itself, it's so hard from a client perspective to say, all right, you have a benchmark, but your real benchmark is your life, right? It's your goals. It's what you're trying to achieve. How do you work with the problem of benchmarking, especially when the S&P 500 has just been so overwhelmingly strong compared to non-traditional designs?
Yeah, that's a great question because, like you said, it can be, I don't want to say a problem, but it can create challenges. So I would say with relating to our discretionary platform, our number one goal is just to provide a consistent, attractive, risk-adjusted return over a full market cycle. Um, Really, with the ultimate goal being we want our clients to stay invested and meet their objectives and try to avoid them, leaving the market at the most inopportune time, which, and I've seen that time and time again. So our goal is really to provide that consistency. But with that, that means when you see a strong momentum driven market, my expectation for our portfolios is that we're probably going to lag benchmarks. But on the other side is when you see, any kind of drawdown, we're going to hold up better is the expectation. So, like any other, I would say, managed portfolio, we do have blended benchmarks that are comprised of, varied combinations of the broad market indices. But one thing I worked on a few years back, which I think is helpful, particularly, like you said, in periods such as this year and last year, where markets are really categorized by extremely narrow breadth, where it's a handful of stocks that are essentially driving the returns in the S&P 500. We created our own proprietary peer groups as another way to monitor performance. So these peer groups are just managed accounts similar to what we do. I put together a presentation every quarter, send it out to all the advisors, which really helps them, just provide a better context, I think, for how we're performing relative to the broader universe. And then we also, I guess, in terms of our manager selection, we we take a quantitative and a qualitative approach. So the first step that we do is we created a proprietary scorecard through Morningstar Direct, which essentially ranks all of the active managers within I should preface all the active mutual funds within the universe based off a combination of various performance and risk metrics versus the appropriate Morningstar peer group. So that's helpful as well in that we're looking at manager performance not only versus the benchmark, but also versus its peers over a long period of time. And that just gives us a more broader viewpoint and allows us to make better decisions in terms of selecting those most attractive managers that we believe are going to add alpha over time.
Yeah, it's interesting because the difference with I need working more with the family office side, although he does work with the other side as well. The focus on tax adjusted returns, and you're talking about risk adjusted returns, right? But well, I mean, obviously, having both of those things are fantastic together, so it could be more widely used across all clients. But it just talks about the different perspectives that you might have, as asset managers, right?
Yep.
And John, where do you think that you'll add the most value? What type of market should you say, hey, I'm really glad I have Blueprint here?
I mean, as a card carrying, dutiful trend follower that I am, the easy answer is to say, we're going to really shine in a bear market scenario. But I mean, that argument really only goes so far, right? Because if you just think of these discrete periods of time, a bear market, was 12 to 15 months, and a bull market, depending on who you ask, is eternal. So we're experiencing a pretty prolonged one right now with a few hiccups. And as a trend follower, we cut our losses short and let our winners ride. So we don't make predictions, we don't make guesses, we don't want to get in the way of the trend, because we have this braking mechanism where we're going to get out in the second or third inning of the start of the new game. Mm-hmm. But we just don't know how many innings this game's going to go. So the way we've designed our strategies is not only do we have, the risk-based strategies that we've all sort of hit on in this conversation of anything from super aggressive all the way down to conservative, but we layer in. So if you think of that as a vertical vector, we try to cut that horizontally by giving the advisor and or the client the opportunity to pick how much trend following do they want driving the asset allocation. So this sort of hits at the behavior as well, maybe directly on the ground, but indirectly in terms of the selection process or the selection criteria, because often people don't know. Right. They say, hey, I'm in distribution mode. I'm taking 4% withdrawal rate out of the portfolio. Therefore, I want the highest tactical strategy you have, meaning I want trend following to have the most influence over the asset allocation, and then that strategic portion to be lower. And then they get into a period of time where you get inevitably a false positive, right? In terms of or a type 1 error, if you will, in markets. And then they lag. Even though we may be winning on the risk side, we might be lagging slightly on the return side. And then that's when the rubber meets the road. That's when they really have to decide, okay, am I willing to sit through this to preserve what I have later? Or am I just too uncomfortable with FOMO in the moment? And we're agnostic to what advisors choose. That's why we've designed the platform like we have. So I would say our expectation is that we're going to peer perform, but we're okay underperforming in a bull market. And then my expectation would be over that full market cycle, we're going to outperform, or at least have it, because of the drawdown limiting nature of trend following, we're going to outperform on a risk basis in a bear market. Now, the reason that I say that our expectation at least is that we're going to peer perform because markets fall 2 to 3 times faster than they rise. And so if you're trying to cut out the worst parts of it, not all parts, for everybody listening, Blueprint does not we are not picking tops and bottoms necessarily as trend followers. And we're fine with that. But we gear the portfolio a little more aggressive, apples to apples, than a traditional asset allocation portfolio. So for example, I'm saying that, I acknowledge typical on average balanced portfolios, let's say a 60-40. We're going to gear that portfolio up because of the trend following to about 65 to 67%. At 5 to 6% more in a prolonged bull market, depending on what segment of the equity market you might be in or might not be in, frankly, that can compound over time. And that's how we maintain or limit the passive portfolio's ability to run away from us, even if we have one of those false positives in the market, because we just trust, and the data has shown us and the track record shown us that eventually when it turns, we're also going to turn, but only for so long.
If in the game of musical chairs, right, 99% of it is the music, and there's only about 1% of it is the actual sitting down, right? And if you're the last one standing, it's really going to be tough. And that's the toughest part about your jobs, is that long term, right? You don't want your client to be the last one standing, right? Because that's their retirement. They just worked all their life, their hard-earned assets and everything else, and they get caught in that one financial crisis moment. And if they're in the wrong allocation, I mean, I've seen it firsthand how much damage that can do, right? So we got a couple of questions just from the audience, and then we'll wrap it up. Are long-term bear markets dead? That's a good question. I mean, you mentioned that there's 12 to 15 months. I think it used to be 18 to 20 months, the average bear market, right? So are long-term bear markets dead? Anybody want to jump in on that?
Well, the one, I guess I'll start off to answer it succinctly. I don't know, but I've had seen the trend being more recently is the expectation of a V-shaped recovery every time we see a market drawdown, and this expectation of investors are buying the dip, which are propping up markets. And also, the expectation of the Fed put, anytime we have any kind of weakness, the Fed is going to step in and, essentially save the economy. It's a pretty timely question because we're approaching 2:00. So let's see what happens with the Fed today. But I guess, that's been the situation over the past, I would say since COVID, where we see that V-shaped recovery. I, however, don't think that's going to be sustainable going forward, particularly because a lot of market movements right now are being driven by sentiment as well as policy, and the Fed has this razor thin margin of not making a policy mistake. They're trying to juggle inflationary pressures from tariffs, coupled with a weakening economy that's starting to show up within the labor market. So I guess I mean, I don't know the answer to that, but my thought being is we're not going to see these V-shaped recoveries, no, going forward forever.
Yeah, it's been more battles than wars, and when you talk about bear markets, and Anit, I knew you were looking to jump in on that as well. You know, what are your thoughts?
Well, I think that's spot on. A different way of asking that question is, do business cycles still exist? And that's really what we've been kind of paying attention to. Of so much of what we have watched in the boom bust cycles of the past 20 years. I started in '98, and I think the only real cycle that we encountered was post-dot-com bubble. GFC was obviously induced by housing and bad finance and caused its own different thing, but it was very different. They've all been very different. And in recent years, they've all been generally not policy induced. It's been exogenous factors. So I think one question is, are they dead? I think the answer is probably no. I think the real thing is, when do you think the cycle ends, if there are still business cycles? All the work that ECRI has shown, all the work that we've seen in the traditional leading indicators have all but called the end of a cycle at some point in time over the past 2 years, if not past 7, 8. And then here you go, to Lee's point, the stick saved by the Fed or other policy, and next thing you know, you're out. So hard to say never, because the minute I say never, it's going to happen, probably, knowing my luck. But I think the real question is, what happens to business cycles?
There's a lot of portfolio managers that retired bearish.
Yeah, absolutely.
Yeah.
Yeah. Markets tend to go up, right? So,
Yeah.
like John said, it's like you could spend the rest of your career being bearish, and if you're wrong, it's on the other side of that, right? I talked about the one person standing, but and then you're kind of standing forever.
Macro's hard. Macro's tough. It's
Yeah.
trying to figure that out is asking for pain.
And everybody's got an opinion. I've watched CNBC on occasion where two people have different opinions, and they both seem way smarter than me. And we're going to end it there because, as Lee said, we got some news coming up at 2:00, and want to make sure everybody has preparation for that. Just want to say thank you so much for all of you for coming on today. I really appreciate your time. And I look forward to getting some of this information out to those that were able to attend today, as well as those who weren't. So we'll make sure we get this out to as many of the folks that really care about financial services and asset allocation and creating portfolios that can last for the clients. And really, it's about the clients and helping them get to their goals at the end of the day. And this is great work we all do and we all care very deeply about. So I really appreciate the time today.
Yep. Thank you, Jeff.
Thank you.
Thanks, Jeff.
You're welcome. We'll see you next time on Investment Mastermind.